Market volatility may provide a challenge for investors. Given how quickly the market may move, choosing where to invest in order to maximize returns and minimize risks may be difficult. We'll be looking at a number of investing ideas for choppy markets in this video so you can get the most out of your money. Diversified portfolios. One of the best strategies for a successful investment portfolio is diversification. This suggests that you should diversify your investments extensively, accounting for a variety of variables like your risk tolerance, industry, region, and more. For instance, if you just invested in stocks, the market would decline and the prices of the stocks might decrease. If you diversify your investments by holding a mix of stocks, bonds, cash, and maybe even commodities like gold, your risk is spread over a number of asset classes. Your experience during a collapse could be less tumultuous as a consequence. Additionally, having a diverse portfolio could provide you flexibility if one particular area has a slowdown. As a result, many shrewd investors devote less than 20 to 30% of their portfolio to a single sector or asset class. Dollar cost averaging. The dollar cost averaging (DCA) strategy is yet another excellent way to profit from investing. A DCA investor uses a predetermined amount of money to make the same investment over an extended period of time. This lowers the risk associated with market volatility since only a small portion of your purchase will be influenced by any one major fall or rise in market price. As a result, over time, your wealth may rise while the investor's purchase price finally decreases. Growth stocks. Growth businesses are those that have the potential to have above-average growth over sustained periods of time while looking for additional capital. This is owing to the possibility that they represent a big portion of a developing economic region or that they may be a component of a rapidly expanding industry. Investors looking for growth stocks should research the company's fundamentals, including its revenue growth, earnings history, and potential catalysts in the future. Take into account these elements as well as the prospect of slower development rates in certain businesses over time. Hedging strategies. Investing in assets that might normally go in the opposite direction from the one you are hoping to gain is known as hedging. One may be playing the market from both sides by selling a stock that is declining and simultaneously buying one that is rising. It could also include purchasing puts and calls, as well as investing in futures, foreign exchange, or other derivatives products. Whatever the vehicle, the main purposes of hedging are to profit when markets move against an investor's investment and to protect against losses. However, investors should exercise care since poor market management might lead to losses. Consider investing in bonds. Bonds are a different asset class that investors should consider. An organization or the government receives a loan with a set interest rate for a certain amount of time when they issue a bond. This means that at bond maturity, investors will get fixed income from the bonds at the predetermined rate for the duration of the loan. Convertible bonds could be the ones that appeal to investors the most since the investor is the guarantee of the loan included in the bond, which sometimes gives high rates of return. Utilize defensive strategies. Investment losses are a possibility, which is a disadvantage. When losses are significant, it is best for investors to take protective action. Dollar cost averaging, safety nets like investments in collateralized debt, or deliberately reducing assets ahead of potential big losses are a few examples. Additionally, investors have access to stops, additional safety measures like margin calls, and actions that limit the amount of transactions. Another option is to hedge, which involves incurring a loss on one side of an investment while attempting to generate a profit on the other in order to progressively recover the original investment over time. Invest in long-term assets. Long-term assets including precious metals, bonds, government securities, real estate, and even exchange-traded funds, ETFs, are often seen as safer investment alternatives by investors. These investments often take longer to pay off, sell over the long term, but they may end up being highly lucrative over time, especially during periods of moderate to high inflation. Investors may, for instance, pay less for real estate and hold it for a profit in the future. When shopping for assets other than stocks, just be cautious not to spend more than you can afford and be mindful of the dangers involved. Increase cash reserves. A great strategy to safeguard your possessions over time is to increase your cash reserve. This simply implies having a range of assets that you can rapidly turn into cash if required. It does not mean that you need to have more money in your checking account. With a cash reserve, you can guard against unusual circumstances like illness or financial difficulties in addition to market volatility. A further advantage is having assets you can quickly sell if the market declines, allowing you to invest at lower costs when the market turns in your favor. Invest in high dividend yielding stocks. Investors are usually drawn to stocks with high dividend yields, especially those who have little to no appetite for risk. A firm has the right to provide us with these stocks at a preset high rate of return. Some dividends may be reinvested to generate more consistent growth over time, while other dividends are given out on a monthly or quarterly basis and can assist investors in moving forward with their financial goals right now. Some companies even provide slightly higher rates to shareholders who continue to invest in their company. This may assist produce consistent earnings even during market downturns. Take advantage of market opportunities. If given the chance, many investors may be convinced to take advantage of advantageous investment possibilities. Depending on whatever markets, foreign exchange markets, stock exchanges, futures, or even cryptocurrency markets, may fit your goals and risk tolerance, being proactive in searching for exceptional possibilities may pay you in the long run. Many expert traders create market-specific strategies to help them outperform the averages. Utilizing the resources provided to investors may also help in locating various strategies and methods that many seasoned investors utilize when making judgments. Be willing to adjust your portfolio often. Given that the world is always changing, it is advantageous to keep an eye out for evolving patterns in the markets you are investing in. Analyzing macroeconomic patterns and market movements may enable you to identify new opportunities for profit or shield you from potential losses in the future. In order to outperform the market, keeping an eye on news sources, investing forums, and trend spotters may be beneficial. When conducting trades, bear in mind the taxes and fees associated with extracurricular activities, and include such expenses when determining your profits or losses. The best strategies to stay on top of the markets are to monitor market changes, alter your portfolio as needed, and be cautious before investing a lot of money in one transaction. This is it for today's video. What do you think of our video? Let us know in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.